The UK property market just went through its biggest transformation in decades, and most people have no idea what just happened. Mortgage rules quietly loosened to push more money into the system. A record wave of landlords abandoning ship while corporate giants swoop in to buy entire streets. Tax proposals that could hit nearly every home worth over £500,000. And a supply surge that's doing the opposite of what you'd expect. Whether you own property, rent, or you're desperately trying to get on the ladder, what's unfolding right now will affect your wealth, your choices, and your future. This isn't just another market cycle. Something fundamental has shifted, and once you see it, you can't unsee it. Before we dive in, smash that like button and subscribe to Property Reporter for the latest news and analysis that actually matters. We cut through the noise and bring you the facts other channels won't touch. Let me walk you through exactly what's happening, starting with the change that's flying completely under the radar. Back in March, the Financial Conduct Authority sent out guidance that most mainstream outlets barely mentioned, but it's already changing who can and cannot buy a house in Britain. Since the 2008 crash, every single mortgage application has been stress-tested. Banks don't just check if you can afford today's rate, they test whether you'd survive if rates suddenly jumped by 2, 3, even 4 percentage points. The logic made sense after the financial crisis. Protect borrowers from getting in over their heads, protect the system from collapsing again. But here's where it gets interesting. Interest rates are falling in 2025, yet lenders have been stress-testing applications as if rates were about to skyrocket. They've been using reversion rates, those punishing rates you roll onto after your fixed deal ends, plus extra margin on top. In practice, this locked out thousands of buyers who could easily afford their mortgage at current market rates. The FCA finally told lenders they had far more flexibility than they were using. Base your stress tests on realistic expectations for the next 5 years, not worst-case doomsday scenarios. If rates are trending downward, your tests need to reflect reality. They also reminded banks about their consumer duty obligations. In plain terms, don't design your lending criteria in ways that unfairly exclude people who can actually afford to borrow. This is a quiet but significant loosening of the rules. It's not as dramatic as scrapping stress tests entirely, but it's a clear signal from regulators that they want more approvals, more transactions, more activity. Then, in July, the FCA dropped an even bigger update. They simplified the entire mortgage rulebook, stripped away old red tape, and made it significantly easier for people to switch lenders and reduce borrowing terms. Remortgaging became smoother. You can now pay off your mortgage faster without drowning in paperwork. You can have informal conversations with lenders without triggering full regulatory advice requirements every single time. The system is loosening, and it's happening fast. On top of all this, the loan-to-income flow rate limits changed. From July onward, only lenders issuing over £150 million annually have to follow the rule limiting high loan-to-income mortgages to 15% of their lending. Smaller lenders are exempt. What does that mean for you? More lenders can now offer 5, even 6 times your income instead of the old 4 times standard. And there's a new government mortgage guarantee scheme available to lenders, making it easier to approve buyers with smaller deposits. So here's the question nobody's asking out loud. Is this about helping people, or is this about keeping house prices inflated? Because when you make it easier to borrow, you don't just increase affordability, you increase demand. And with supply still so constrained, that demand doesn't make homes cheaper. It pushes prices right back up again. The government and regulators want growth, want movement, want transactions. But growth, built on easier credit, has a nasty habit of ending badly. We've seen this movie before, which brings us to the next force that's colliding with all of this. Rightmove and Zoopla are both reporting the highest number of homes listed for sale in over a decade. Listings jumped 10% year on year, which sounds like great news for buyers. More choice, more competition among sellers, better deals. Except there's a problem. Demand only increased by 4%. That gap matters. Sellers are now chasing buyers instead of the other way around, and it's creating a very different dynamic than what we saw during the pandemic frenzy. Zoopla's forecast predicts house price growth will slow to between 1.5% and 2% for 2025. When you adjust for inflation, that's essentially flat. Some regions might see small increases, others might see slight declines, but the overall picture is stagnation. So why are so many people suddenly selling? It's not because the market looks attractive, it's because they have no choice. Remember all those buyers who locked in ultra-cheap mortgage deals back in 2020 and 2021? Rates were sitting at 2%, sometimes even lower. Those fixed-term deals are expiring now, and homeowners are facing a brutal reality. Their monthly payments are jumping by 30%, 40%, sometimes even 50%. Thousands of households simply can't afford to refinance at today's rates, even with the relaxed lending rules. So they're selling instead. This isn't a trickle, it's a wave, and it's only just started. Estate agents across the country are seeing the same pattern. Motivated sellers, realistic pricing, longer time on market. Properties that would have sold in days during the pandemic are now sitting for weeks or months. Buyers have more power than they've had in years, but only if they can actually get mortgage approval and afford the new rates. The supply surge should be good news, but it's a symptom of financial stress, not market health. And here's the kicker. The government knows this. That's exactly why they're so keen to loosen lending rules, make it easier to borrow more money, push more buyers into the market. Because if they don't, if demand stays weak while supply keeps flooding in, prices don't just stagnate, they start falling. And falling house prices terrify policymakers more than almost anything else. Property wealth props up consumer spending, funds retirement plans, backs loans across the entire economy. A crash doesn't just hurt homeowners, it threatens the whole system. But while everyday sellers struggle and compete, a completely different group is making their move. The Renters' Rights Bill and mounting tax pressure are driving landlords out of the market at an unprecedented rate. On the surface, that sounds brilliant. Fewer landlords competing for properties means less competition for first-time buyers, right? Except it's not that simple. Short-term, rental supply is dropping hard, which means rents are climbing even higher. Long-term, the landlords who are leaving aren't the ones tenants should want to lose. The government commissioned the English Private Landlord Survey, published just last December. This wasn't some biased think tank report. This was neutral, statistical, government-funded research into how different types of landlords actually behave. And the findings are uncomfortable. Large landlords, those with 5 or more properties, are twice as likely to have evicted a tenant in the past year. They're significantly more likely to raise rent between tenancies or during renewals. 75% of large landlords increased rent for new tenants. 63% raised it for renewals. They adjust rent based purely on market conditions. No emotion, no leniency. Small landlords, those with just 1 or 2 properties, are far more likely to hold rent steady, especially for long-term tenants. They're often emotionally invested, more flexible, more willing to work with tenants going through tough times. And according to the government's own survey, these small landlords are the ones planning to sell. Increased regulation, reduced tax relief, uncertainty around the Renters' Rights Bill. Those are the top reasons they're getting out. Who's staying? The big players. The ones with 5, 10, 50, 100 properties. The ones more likely to evict, more likely to maximise rent, more likely to treat tenants like line items on a balance sheet. So while the stated goal is protecting renters, the actual policy is pushing out statistically better landlords and leaving behind the ones tenants are most likely to have problems with. This is the same pattern playing out across every industry. Local coffee shops buried by Starbucks, family-run chippies replaced by soulless fast food chains, black cab drivers pushed out by Uber's algorithm. Not because the big players are better, but because they can handle red tape at scale, absorb regulatory costs, and optimize through systems. What do we lose? Personal service, flexibility, local trust. That's exactly what's happening in the rental market right now. This bill will widen wealth inequality, not solve the housing crisis. It's consolidating rental property into fewer, wealthier hands. Corporates, institutions, and large portfolio landlords are piling in, while ordinary people are being squeezed out. Which leads directly to the most alarming development of all. We're no longer just competing with everyday landlords or small-time investors. We're competing with BlackRock, Lloyds Banking Group, Granger, Legal and General. These aren't companies dabbling in property. They own thousands upon thousands of homes, not scattered individual purchases, entire developments, whole streets bought before they even hit the open market. BlackRock has gone so far as to buy stakes in brick manufacturers. Think about that for a second. They're not just buying finished homes, they're controlling the supply chain, the actual building blocks of UK housing. That's how confident they are that this market is worth dominating. Blackstone, another massive player, is buying up railway arches, land banks, anything with development potential. Why? Because housing has become one of the safest, most profitable investments in the world. Inflation makes rents go up. Debt stays fixed or gets cheaper in real terms. People always need somewhere to live, no matter what happens to the economy. Even when everything else collapses, people pay rent. They have to. It's not optional. These corporations understand something fundamental that most individuals miss. Housing isn't just shelter anymore. It's a financial asset class, and it's too profitable to leave in the hands of ordinary people. Remember Maslow's hierarchy of needs from school? Food, water, shelter at the bottom. The absolute essentials for survival. Corporate landlords know they're providing one of those essentials, which means demand is completely inelastic. Tenants can't just decide not to rent. They can't boycott or shop around indefinitely. They need a roof over their heads, and they'll pay whatever the market demands. That's why institutional investors see UK housing as a goldmine. This shift fundamentally changes the game. When your landlord is a person, there's room for negotiation, for human understanding, for flexibility during hard times. When your landlord is an algorithm optimizing returns for shareholders, you're just a data point. Rent goes up because the model says it should. Maintenance gets delayed because it impacts quarterly profits. Evictions happen faster because there's no personal relationship slowing down the process. The buy-to-let exodus isn't creating opportunities for regular buyers. It's creating a feeding frenzy for institutional capital. And once these corporations own enough of the housing stock, they don't just control shelter. They control a massive portion of household income, consumer spending power, and economic stability. That concentration of power should concern everyone, whether you rent or own. But the final force reshaping UK property might be the most explosive of all. HMRC pulled in almost £15 billion from stamp duty last year, and that's despite transaction volumes being down. The tax take from property is enormous, and the government knows it. But behind closed doors, think tanks and policy advisors are pushing for something much bigger. A land value tax that would replace both council tax and stamp duty. Leaked proposals suggest a new levy specifically targeting homes worth over £500,000. If that sounds like it would only affect the wealthy, think again. In London, you can find two-bedroom flats going for £500,000. Across the southeast, ordinary family homes are well over that threshold. This isn't about taxing oligarchs and mega mansions. This is about extracting more revenue from middle-class homeowners who've watched their property values climb, not because they're rich, but because the market went insane. The political appeal is obvious. Property wealth is concentrated among older voters who already own homes. Younger voters, locked out of ownership, are far more supportive of taxing property wealth. It's a tempting way to raise revenue without touching income tax or VAT. But the consequences could be seismic. Homeowners over the threshold would face annual bills potentially worth thousands of pounds. Some would be forced to sell. Others would see their retirement plans shattered. The southeast property market, already under pressure, could face a sudden correction. Nobody knows exactly what form these tax changes will take or when they'll arrive, but the direction of travel is clear. The government needs revenue, and property is one of the few places left with substantial untapped wealth. Stamp duty already raised £15 billion in a slow market. Imagine what a comprehensive land value tax could pull in. The risk is that it tips the market into a spiral. Forced sales increase supply, prices drop, more homeowners find themselves in negative equity, more forced sales follow. It's a feedback loop that's very hard to stop once it starts. Here's where we actually are. Mortgages are easier to get, which sounds positive until you realise it risks inflating prices all over again. Supply is surging, but mostly because people are being forced to sell, not because the market is healthy. Small landlords are fleeing, but corporate giants are circling like vultures, ready to snap up everything they leave behind. And tax proposals are being drafted that could upend the entire market for anyone with property worth over £500,000. These 5 forces aren't separate issues. They're connected, feeding into each other, creating a system that feels increasingly rigged against ordinary people. Easier borrowing props up prices so sellers can exit without crashing the market. Landlord exodus creates opportunities for institutions to consolidate power. Tax changes could force more sales, giving corporations even more buying opportunities. Everything points in one direction. Housing is being transformed from something people own into something people rent from massive corporations. The UK property market hasn't just shifted in 2025, it's fundamentally changed. The question isn't whether you like these changes. The question is whether you understand them well enough to make smart decisions for your own situation. Do these forces stabilise the market, or are we heading towards something completely unrecognisable? Drop your thoughts in the comments. I genuinely read almost every single one, and I learn from your perspectives. If you found this breakdown valuable, subscribe and hit the bell so you don't miss the next update. More importantly, share this with someone who needs to understand what's really happening. The more people who see through the noise, the more pressure we can put on policymakers to actually fix the system instead of just propping it up. What happens next affects all of us, whether we own, rent, or we're still trying to get that first foot on the ladder. Knowledge is power, and right now, we need all the power we can get.